high yields mean higher risk, but I'm currently holding 7 funds that yield more than 12%. Most of the allocations are small because of that risk, but small allocations can yield big rewards. Today we'll look at how 7 funds generate crazy yields and why I hold them. I keep my portfolio in the 8 to 12% range. The current high interest rate environment makes that a little bit easier, so it's currently closer to 12 than 8, around 11%. And a small allocation to these 7 funds helps keep it there. Of the bunch, QQQI is the sensible one, which is why it's by far the largest allocation of any of the funds we'll look at today. It's 5% of my portfolio, which is the max I allocate to any one investment. At almost 14%, the yield is high, but not as crazy as some of the others we'll look at today. And it's based on one of the best indexes ever created, the NASDAQ 100. The income is paid monthly and it's fairly consistent. QQQI simply holds the same stocks as the NASDAQ 100, which pays almost no yield. Then they sell call options on the NASDAQ 100 index. If you're not familiar with covered call funds, I'll link this video that explains how they generate income. If you don't need the income, the NASDAQ is better over the long term. But if, like me, you do need the income, the 13+% yield is nice. I need it because I retired back in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. THQ yields roughly the same as QQQI in the 13s, but unlike QQQI, lately, it's been a dud. It's my worst performing investment. So what's the deal? It's focused on a troubled sector, healthcare. THQ's largest holding, Eli Lilly, is down 27% over the past 12 months. Its second largest holding, United Health, was once the darling of Wall Street, then down 52% over the past year. And then as I was preparing this episode, Warren Buffett bought some United Health, so UNH and THQ both got a little pop. Maybe his buy signals the bottom for healthcare. Now, I don't love healthcare because it's heavily influenced by government policy and regulation, even more so recently. There are concerns about potential changes to drug pricing regulations and Medicare plans. THQ generates most of its distributions trading healthcare stocks, and if they're losing value, that means they'll distribute some destructive return of capital. We can see signs of that in this recent breakdown from CEF Connect. Some investors think healthcare is now undervalued. I'm just in it for some diversification and continue to hold an allocation of just over 1%. On a brighter note, it does have a history of consistent distributions going back more than 10 years. Moving on to credit, and we have 2 funds paying juicy yields. PDI comes from PIMCO, one of the biggest closed-end fund managers in the world, and that distribution chart goes all the way back to 2012. Only a small amount of growth in the income, but no cuts, which is a plus. PDI holds a huge portfolio of credit investments. The 2,000-ish holdings include high-yield corporate bonds, mortgage-backed securities, and emerging market bonds. If you're looking for non-US exposure, this fund is about 30% non-US. It's been doing quite well recently, especially for a credit fund, so I have no complaints, but that also means it's become relatively expensive. If you trade in and out of closed-end funds based on discounts and premiums, this is one you'd probably take profits on at the moment. We're breezing through these quickly because we're covering 7 funds today, but I've reviewed most of them in more detail, so I'll link to those reviews in the description. GOF or GOF is the other credit fund for today, and if you think PDI's 13% premium to NAV pricing is a bit rich, check out GOF's Nosebleed 29% premium to NAV. That's why I hold an allocation of less than 1%. The 14% yield is nice, but when a premium is that high, any bad news will hit the price hard. GOF is popular because it has a long history of consistent distributions. This chart goes back 18 years and it looks pretty cool. The long-term total return won't set the world on fire, but it's a credit fund, so it's not supposed to keep up with the S&P 500. One very popular way to diversify into bonds is to buy investment-grade bond funds like BND and AGG. These two funds alone have about $500 billion of assets under management. They offer less volatility than a fund like GOF, as you can see on this 10-year chart, but that ignores the income, which is most of the reason for buying a credit fund. This 10-year total return chart includes the income, and it's a different story. I'm not telling you which fund to buy. In fact, I think GOF is a bit overpriced. I'm just saying don't buy a fund because somebody tells you investment-grade bonds are safe, and that's what everyone does. The GOF portfolio has about 1,500 holdings, and like PDI, it's a credit soup with many ingredients, but the majority are bank loans and high-yield corporate bonds. I bought GOF back in Feb of 2024, so I've done all right out of it, but at the current valuation, it is risky. I haven't done a full review on this fund because it's one of my smallest holdings, but this analysis by Kane Lee is excellent. He breaks down the holdings, the strategy, and most importantly, the NAV erosion. If you're tempted by the excellent distribution history, I'd read this analysis before buying because the timing of when you buy makes quite a difference. I've read a few good articles by Kane recently. He's one of my favorite authors. Here's a list of all my favorites. If you're not using Seeking Alpha to learn about income funds, it's definitely worth checking out. I'll put a link in the description for a discount and a free trial. I use it every day. Our last three turbocharged high yielders are Bitcoin related. They don't own actual Bitcoin, but they use Bitcoin futures, ETFs, and options to generate income. A lot of income. BITO was launched in 2021, making it relatively old by Bitcoin fund standards. It uses Bitcoin futures to replicate the price of Bitcoin. The distributions are, well, all over the place, which is normally a deal breaker for me, but on average, they're well above 50 cents a month. Even if the distributions drop down to 50 cents, that's still an annualized yield of 28% on today's price. One interesting fact about BITO is that they launched it just before Bitcoin crashed. Remember how the 2022 bear market sucked for the S&P 500? Well, it was a lot worse for Bitcoin. If you bought Bitcoin or a Bitcoin fund at the worst possible time, you could have taken losses of more than 60% in 1 year, assuming you also sold at the worst possible time. And whether you held actual Bitcoin or BITO, the results were similar. Of course, if you didn't sell, the losses eventually became gains. That terrible timing of buying BITO at inception, just before the crash, would have resulted in a negative total return for just over 2 years, then back to zero, well, for a moment, then back into the red again for most of 2024, and then a nice recovery in 2025. The income from BTCI is far more consistent. The yield is typically in the high 20s, and the distributions have all been well over $1. The yield will look lower on most websites as I record this, but that's temporary. It's because BTCI is less than a year old. The most common yield formula is dividing the past 12 months distributions into today's price. If the fund is only, say, 10 months old, then they're dividing only 10 months of distributions into the price, so the yield will appear artificially low. Another way to calculate yield is to take the most recent distribution, multiply it by 12, and then divide by the price. If the distributions vary, then all these numbers will be constantly changing. It's for this reason that it's important for income investors not to just blindly accept every yield number they see. I've excluded IGLD from today's list because its yield was skewed by a recent special distribution. The regular distribution for IGLD annualizes to 7.2%, not 17%. So which strategy is better, BITO's futures or BTCI's options? Looking at total return since inception, they're pretty similar. BITO is currently slightly ahead, BTCI offers more consistency, and both have crushed the major stock market indices. Also worth noting that BTCI is more tax efficient than BITO because the distributions include some return of capital. MSTY is the wildest of the bunch because it adds leverage to the equation. The quoted yield on some websites is 151% based on trailing 12 months of distributions, but that includes some unusually large distributions from late 2024. If you simply multiply the last $1.18 distribution by 12 and then divide by the price, then the yield will be closer to half of that 150 number, which is how Snowball calculates it. And Snowball is handy for distribution charts like the ones we've seen today, but I mostly use it to combine my stocks from 3 brokerages into one simple dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. MSTY uses options to replicate the price movement of MSTR, aka MicroStrategy. This company buys and holds actual Bitcoin, a lot of it, just over $74 billion worth as I record this. The leverage consists of convertible bonds and preferred shares issued by MicroStrategy. Of course, leverage increases the risk, and during a bull market, it increases the return. And that's what's been happening recently, a bull market and higher returns. Remembering that Bitcoin can easily crash by more than 50%, this is a leverage version, so the risk is higher, and it was launched during the good times. This is the total return for MSTY since its February 2024 inception. Quite impressive. Let's finish this Bitcoin section by comparing all 3 since the newest one, BTCI, was launched on October 17, 2024. MSTY's massive lead shrank, and the 3 have converged to quite similar total returns recently. With the exception of QQQI, my allocation to these turbo yielders is pretty small, and the risk is high. So why bother with small allocations to high risk? The short answer is the upside is greater than the downside. The total allocation for the 7 is currently about 12% of the portfolio. The income they produce is a different story. Those 7 funds produce 27% of the income. That's a substantial contribution. Of course, the income varies a lot, and some of these could lose a lot of value in a down market. Let's say the market crashes and they lose 50% of their value. Half of 12% is a 6% hit to my portfolio value. Not too bad. Typically, income is less volatile than price, remembering that several of these funds have never actually had a dividend cut. Let's say the income falls by an average of 33%. And by the way, this recent episode looks at what happened to a covered call fund when the Nasdaq fell 50% during the 2008 global financial crisis and the income fell 30%. Assuming the rest of the portfolio, which is more conservative, did not experience cuts, then a third of 27% is a 9% reduction in the portfolio's income. That would suck, but it's not the end of the world. More importantly, it's a reduction from a number that doesn't exist if I don't hold these riskier investments. Glass half empty is to say, what if your income is reduced by 9%? And glass half full is to say, without these turbo yields, your income would never have been that high in the first place. Also worth noting that QQQI skews the numbers. It's by far the largest holding in this group and the least risky. If we remove it, the other 6 turbo yielders make up just 7% of the portfolio. However, that 7% adds a whopping 21% to the income. My approach to the risks posed by these high yielders is number 1, small allocations. Number 2, don't consider all the income they produce as spendable income. On average, these funds don't grow in value. If you spend all the income, there's a risk of NAV erosion. In other words, I'm saying that I reinvest most of it. In round numbers, if it yields 30%, I'm spending 8 and reinvesting the other 22. Number 3 is I don't drip these, meaning when I say reinvest, I don't mean reinvest back into the same high-risk fund. I mean reinvest into whatever income investment opportunity looks most attractive outside these high-risk funds. It could be a preferred share like EICC yielding 8%. The more time that passes, the more this excess cash gets reinvested into lower risk income investments, the less total risk across the entire portfolio. I realize there are people who invest a lot of money into high risk investments and then reinvest them to compound returns with the hope of getting rich. That's not my goal. I'm not trying to maximize total return. I'm not trying to die with the biggest portfolio. I'm looking to consistently grow income over time. That's all. I'm not suggesting to copy these allocations or my portfolio. Everyone has different risk tolerances. The point of this episode is just to share the logic behind these decisions. If you enjoy adding a little spice to your portfolio, I'll link to these in-depth reviews that explain how the funds mentioned today generate their yield. That wraps it up for this look at turbo yields. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.